Hey, it's Soleil, and this is episode 218 of the Orange Pill Investor. And today I want to talk about spreads from an option seller's perspective. I mostly deal with credit spreads, but we'll go over the debit spreads as well. I went ahead and set up a CLSK debit spread in my main account. Well, I guess it was in the one of the main accounts, just for demonstration purposes. But I'm going to go over several of the most common ones today. And the first thing that you want to look at is liquidity. So normally what I'm doing is just selling puts and covered calls. And in that scenario, I only have to deal with one bid-ask spread. So if I was trying to sell this put in MicroStrategy, this bid-ask spread is 10 cents wide. That's only a day away. And these spreads are going to be like way out here, approximately 45 days to expiration. So let me scroll down here. Let's check the 100 strike. This is like best case. Nice round numbers like this are best case scenario for getting good liquidity. And this is already a 50-cent bid-ask spread, 315 to 365. And that's not terrible. You can probably get something around the mid-price filled. You might have to sell it for a little cheaper. You know, you might have to go down to 335, 330, 325. But as you start adding legs and start forming spreads, now you're going to have a 50-cent bid-ask spread in this option. And then if I add, I'm going to buy a put as well. Now I'm going to add another 45-cent bid-ask spread. And so you can really get screwed with these. So MicroStrategy is not necessarily something that would be optimal. And if you're on Tasty Trade, they've got like a little star system here, which is just kind of ballpark. And they even say that MicroStrategy is 3 stars. But for spreads, it's not great. It's not great at all. Let's just compare that to some of the other tickers. So Tesla, for example, 25-cent bid-ask spread, and the price of the stock is twice as much. So this is not bad. I may take a look at this one. Apple is one that I used to trade fairly regularly, but even Apple has a 155 to 1, let's say to 95. Yeah, that's 40 cents. So that's not the greatest either. The easiest ones that are going to be able to be set up on like the SPY. So bid-ask spread is always just a few cents. So this is, even after 43 days to expiration, down here at the 537 strikes, bid-ask spread is 9 cents on a $500 and something stock. So you're always going to be able to get fills here. The problem is, when does it even make sense to sell spreads? The way that you win a credit spread is you either have to be right about the direction, meaning if you're selling a bullish spread, the price needs to go up for you to win. Or if you're doing a bearish spread, like a put call spread, then you need you need the stock to trade sideways or down. Or you need implied volatility to collapse. So if you're selling, let's just take a look at, this is Market Chameleon. This is a good place. You can see a nice implied volatility chart. You can get a free account. And when MicroStrategy pumped back in March, implied volatility was through the roof. So at this point, you could sell options while implied volatility is high. And then as implied volatility starts to collapse over time, the prices of the options will decrease, even if the price of the stock is trending sideways. And in that sense, you can sell options here when they're very expensive, and then you can buy that credit spread back at a later time as it gets cheaper. So those are the two ways that you win. You either sell an expensive spread when implied volatility is high and wait for the collapse, or you have to be right about the direction. So if you're bullish on a stock and you sell a bullish spread and you're correct about that assumption, then in general you'll win. Okay, so let me talk about one more thing first. So Apple is actually a pretty good example of a stock. If I saw this chart, I would think this is a decent earnings play. And selling credit spreads the day before earnings are released and then closing them after earnings are released can be profitable. And the reason is because implied volatility is climbing before earnings. There's all this anticipation. So option prices generally are a little bit increased here. And then earnings are released, and regardless, the stock will either go up or down, but option prices generally will collapse by some amount because implied volatility has collapsed, because now the cat's out of the bag and everybody knows what the results of the earnings are. So there's no anticipation anymore. And even if the price of the stock goes against you a little bit, sometimes these can still be profitable simply because of, it's called IV crush or earnings crush. It's a phenomenon where in certain stocks, this is, especially Apple, looks like this is pretty routine. Earnings anticipation builds, earnings is released, implied volatility collapses. So the attempt, and of course this is all not financial advice, but the attempt would be to sell a credit spread here, buy it back the very next day cheaper. You only have to obligate your collateral for like an hour, 30 minutes before close here, and just close them within 30 minutes of the open the very next day, and make a quick buck. When I was doing these, I might have made like 0.5% on average. So it's definitely not going to be tons and tons of money, but it is something that is very quick. That collateral only has to be obligated for literally 24 hours to potentially get, I don't want to call it a scalp necessarily, but you would be doing this many times on many different tickers in order to let, for that to accumulate into something substantial. So those are the scenarios where it makes sense to actually sell credit spreads. Either implied volatility has spiked, and that can be for some news event, or it could be earnings. Or if you're just sure that the price is going to go up, then it's possible that you could sell a put credit spread. And if the price does, trend sideways or up, you could end up making money with that spread. So here's how it works. A put credit spread is a bullish spread, meaning you will profit if the price goes up, or at least stays above the strike in question. So if I was going to sell a put credit spread in Apple, I would go out to approximately 45 days to expiration. That's Tasty Trade's research has shown that theta acceleration is maximized for out of the money options at 45 days to expiration. So I'm going to go out here and sell a put and pick the 200 strike. Since this has to result in a credit, the way that I remember this is, okay, do I set, when I switch this over to buy a put to form the other leg, do I go above or below? In order to result in a credit, you have to go to the cheaper one, which is going to be farther away from at the money. The near the at the money options are going to be much more expensive. So it makes sense that you would have to sell the 200 for more than you can buy the 195. This will result in a credit. That's why it's called a put credit spread. And Robinhood's kind of cool. They give you a little chart. So it'll show you, anything above 200 and you're going to profit. And the max profit is what you're getting paid. And the max loss is the collateral. The collateral is going to be the distance between the two strikes that you selected. So we're actually risking $500 to make $40. And that may not sound like much, but the way that I generally determine whether this is even worth doing is I use the Kelly Criterion formula, which is an equation that gamblers came up with to basically size their bets based on what advantage they think they have on a particular gamble. And it lets them never go broke. As long as they bet within that bet size, then they should be able to continue to gamble into infinity and not completely go bust. So in this, delta is an approximation. It's not exact. It's not guarantees, but it can be considered an approximation for the likelihood that the price of that stock will stay above that strike. So there's an 11% chance, actually, I might have said that backwards. There's an 11% chance that it will breach this strike, that it will actually drop from 222 to below 200. There's an 11% chance that it'll do that. And then the flip to that is that there's an 89% chance that it won't. There's an 89% chance that this would be a winning bet. So in that sense, if that probability holds true, then you would need to collect more than 11 cents per dollar in order to make this trade make sense. Because you're going to lose this bet like 1 out of 10 times. So you need to collect more than that than, you're going to win 9 times out of 10. But that one time that you lose, you're going to lose the whole $500. So you have to win enough on the 9 wins to outweigh that one big loss. And since this is a $5 wide option, you need to collect at least 11 cents per 100. So really, this would not be a credit spread that I would sell, because I would need to collect 55 cents here in order to even break even. So I would probably need 60 or 65 in order to make this a winner. So let's just take a look at Tesla and see if this would be one that I would be willing to take. In this scenario, the delta is 0.16. Again, it's $5 wide. So if this was just $100 between strikes, then I would just literally need to collect more than this. So I would need to collect more than $16 per 100. But since this is 500, I need to collect 5 times 16, which is 80. So this one wouldn't actually be bad. This put credit spread actually makes sense, if if delta is an approximation for the likelihood of that this would be successful or not, this one should be profitable more often than not. If the credit was going to be less than 75 or 80, then the Kelly Criterion would say that this is not worth even bothering with. And again, here's the little chart. As long as Tesla stays above 190, you get to collect the 88 bucks. But the other element to this is, you just like selling regular puts and covered calls, you don't want to hold this all the way to expiration if you can collect most of it early. So if the price of Tesla shot up to 250 and then the value of this spread went from 88 to 10 cents within a week, I'm not going to hold it for another 35 days just to try to collect 10 more cents when I can collect 78 of the 88 cents in 7 days. But if the price of the stock trends sideways, a reasonable expectation would be to collect half of this premium in 2 to 3 weeks. Theta accelerates between 45 days, starts accelerating at 45 days, and that acceleration lasts for a couple of weeks. So you generally try to manage this and collect half of this money. And so what's a reasonable P&L on this? You're going to be risking 500 bucks and probably collecting half of this, so $44. And you'll be collecting that, best case scenario, in 2 weeks. So that's $22 a week and a $500 collateral. So dividing that 22 by 5, you're going to get 4. So about 4% a week is not bad. But of course you have to be right. When you lose, you're going to lose the whole 500, but of course you got paid 88. So in that case, 15% of the time you're going to lose the full, $412. So you have to kind of figure that in as well. So let me just see if I can figure this out. So if we're expecting to win this bet 83 out of 100 times, that's 88 times 0.83. Where's my calculator? All right, that's 73 bucks. Wait, what the hell am I doing? $88. Oh, and then I'm going to lose, so I need to take 412 times 0.17. Let's see, it's 412 times 0.17. Yeah, so this is going to eat into the profits for sure. So I'm going to make $73 versus losing 70. So it is a winning ratio. But this would be, this is just assuming that delta, works. And it's just an approximation. It's not a guaranteed thing. This is all just eyeballing. But over time, it does seem like this would be a winning put credit spread. All right, what if you're bearish? If you think Tesla is worth, less than it's currently selling for, I would do the same thing, but now I'm going to go above the strike price. And let's sell the 275. And in this case, instead of going below the strike, I have to go farther away from the share price. And I have to choose the cheaper option in order for this to result in a credit. And taking a look at the delta, I would need to collect $24 per 100 for this to make sense. So I need to collect, let's see, 5 times 25 is 125 minus $1, so 120. This one would not cut it, because this is saying that I'm going to lose 25% of the time, but I'm not going to collect 25% of the money. So I would absolutely not sell this call credit spread in this scenario. While I'm at it, an Iron Condor is a combination of a put credit spread and a call credit spread. I already set up the call credit spread, and Robinhood is smart enough to let you know that you have formed a short Iron Condor. In this case, the this is kind of an earnings play, or anytime the chart looks like this, that implied volatility has gone up, you could sell an Iron Condor, which is non-directional, and hoping to profit just from this collapse in implied volatility. So the price of the stock really can't go up, and it really can't go down too far in order for you to win this bet. And again, Robinhood's going to give you the graph. As long as it stays within your strikes, you get the full amount. You get the full profit. And in this situation, figuring out whether it even makes sense to do this is going to be kind of the same. So I'm going to take the chances that I lose this bet, which is 22% on the downside, and then add that to the chances that I lose it on the upside. So 22 and 24 is 46. So that means I have to collect $46 for every 100 in order for this to make sense. So 46 times 5 is what, 230? This would not be an Iron Condor that I would sell, because I need to collect more than the probability that I will lose. Let's just see. Nah, I'm not even going to waste my time. But again, when you add this many legs, you have to have a very liquid stock, because now you have 4 bid-ask spreads that you got to deal with here. And you can just look and see, when I go to the next screen, now the bid-ask spread is almost $2. This is a pain in the ass to get fills. Even on something that's fairly liquid like Tesla, it can be brutal. So let's just try one in the SPY. Sell a put, buy one that's a little cheaper. This is $2 apart. I'm going to go ahead and try to make these identically the same number apart just to make the math easy, but you don't have to. You can have a $1 wide spread on one side and 2 on the other, but then it just makes the calculations a little bit harder. So the likelihood that I'll lose this one is 37%. I should have taken a look at this while I was down here. I'm going to scroll all the way back down. Shit, now I already forgot what it was. Was it like, let's see, 22% and 37. So like 59% chance of losing this one. But it's only $2 wide, so I have to double that. It's basically 120. Is that right? I might be screwing something. This is 45 days. Yeah, I screwed something up. What the hell have I screwed up here? Oh, I did 2 cells like a dumbass. All right. Yeah, I should have known because it didn't say short Iron Condor at the top. All right, this makes a hell of a lot more sense. Again, the two losing deltas added up to 59. So there's about a 60% chance of losing this bet, which means I got to collect more than $60 per 100. And this is a $2 wide, so that's 200. So I would need to collect more than $1.20 here. So only 115, I would not set up this trade. But the whole reason I set this up anyway was to show that the bid-ask spread is so much better. Having a 30-cent bid-ask spread on a $500 and something stock is way better than the shit I was dealing with Tesla. All right, let's flip it and go with the debit spreads. So everything in options is basically opposites. So selling a put credit spread is bullish. So setting up a put debit spread is going to be bearish. So I'm going to go up here and, whoops, buy put. I'm going to go up here and buy the 275. And since I want this to result in a debit, I'm going to sell the 270. It tells me I'm setting up a put debit spread, and it gives me the graph. Anything, as long as Tesla stays under 270, then I will pocket this $85. And if it doesn't, if it goes above 270, then I lose the whole $415. I don't really set these up as a matter of course, so I'm not particularly sure when you would do this other than if you were confident about the direction. And so since selling a call credit spread is bearish, then setting up a call debit spread is going to be bullish. So let's go down here and let's buy the 200 strike call. You can see that this is a bullish option. And for it to remain bullish and for it to be a debit, I have to now sell the cheaper one. So I can sell the 205. That results in a debit of $400. And again, it's going to give you a little chart. As long as Tesla stays above 205, then you can collect the $92. But if it goes below that price, you end up losing the 400. I'm not even going to bother showing the reverse Iron Condor. It's basically combining, you know, if the Iron Condor is combining the put credit spread and the put call spread, then the reverse Iron Condor is combining the two debit spreads. And then instead of the price of the stock needing to remain constant and trade sideways, what you're hoping for in that scenario is that the price goes way up or way down by expiration. All right, let's see. Did I cover everything? I covered the 5 different spreads that I wanted to cover and the scenarios when it makes sense to sell them. And those are either as an earnings play because implied volatility has gone up, or because implied volatility has just gone up for whatever reason. Either the price has just fluctuated and gone crazy, or some news has come out and the price has moved considerably based on that news. At that point, it may be valuable to sell an option and then profit as implied volatility reverts to the mean. All right. That's it for now. Be good, y'all.